Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 14th of April. Bank of England to stand pat. Today, all lights will fall on the Bank of England policy meeting, where officials are expected to unanimously remain on hold amid an unclear political environment. At the latest meeting, the bank held policy unchanged and noted that the uncertainty surrounding Britain's referendum on its EU membership could impact investments and economic growth, and is likely to have been the driver of the recent depreciation of the pound. Nevertheless, officials reiterated that the next move in interest rates is more likely than not going to be higher. Even though the CPI rate for March came in above expectations, we don't expect that this will significantly affect investors' rate path expectations, as economic data may be viewed as of secondary importance due to the upcoming vote. Most of the data and surveys for the first quarter so far support that the British economic activity may have slowed, weighed on by concerns about global demand and the Brexit atmosphere. Indeed, the polls suggest a race almost too close to call, something that leaves little room for hike discussions heading into the ballots. Against this backdrop, we will look through the minutes to see whether officials have mentioned the possibility of a rate cut should the situation worsens further, a prospect that was brought to light by Governor Carney in his February testimony to Parliament. Any such reference by bank officials could bring cable under renewed selling interest and perhaps open the way for the well-tested zone of 140.50. Bank of Canada remains sidelined, upgrades economic forecasts. The Bank of Canada remained on hold yesterday and revised up its economic projections for the Canadian economy. Officials noted that the economy's adjustment to the oil price shock will dampen GDP growth somewhat, and that the profile for exports is weaker than previously anticipated due to a weak foreign demand and a stronger Canadian dollar. Nevertheless, the fiscal measures in the March federal budget will have a positive effect on GDP, significant enough to offset these drags. That's why officials shifted their growth projections for 2016 and 2017 to the upside. We maintain the view that the aforementioned fiscal stimulus, the recent recovery in oil prices, and a resilient core inflation rate will be enough to keep officials sidelined in the upcoming months, especially if incoming data continue to surprise positively. We expect the near-term direction of dollar cut to highly depend on the outcome of the Doha meeting on Sunday and the course of oil prices following the meeting. Over the medium term, we believe that the direction of the pair is to the downside, supported by Canada's improving fundamentals and the pessimistic market expectations for the next Fed rate hike. We will reassess our stance if these expectations are brought forward enough to wake up dollar bulls. Overnight, Australia's unemployment surprised the market. Australia's unemployment rate for March fell unexpectedly to a 2.5-year low of 5.7% from 5.8% previously, beating expectations of a rise to 5.9%. Given that at the latest RBA policy meeting, officials reaffirmed their data independency, moving forward, we believe that a sustained improvement in the unemployment trend reduces the likelihood for any further easing in the near term. Elsewhere, the G20 finance ministers and central bank governors will conclude their two-day meeting in Washington, D.C. today. We don't expect any major market-moving news from this summit, but any comments on currency interventions could have an impact on the yen, as Japanese officials have recently said that the previous G20 commitment does not prevent them from responding to one-sided speculative moves in their currency. As for the indicators today, Eurozone's final CPI for March is expected to confirm the preliminary estimate, and thus the reaction in the euro is likely to remain limited at the release. From the US, we get CPI data for March. The headline CPI is expected to have accelerated, while the core rate is forecast to have remained unchanged. This suggests to us that the acceleration in the headline figure may reflect price increases in volatile items such as energy or food, rather than an improvement in the underlying trend of inflation. As a result, we believe that investors are likely to focus primarily on the core figure, where an unchanged rate could keep the reaction in the dollar limited at the release. Additionally, we get initial jobless claims for the week ended on the 8th of April, and expectations are for the figure to have risen. This will drive the 4-week moving average higher as well. We have only one speaker scheduled today, Atlanta Fed President Dennis Lockhart. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.